Welcome to Arnerich Massena's fourth quarter 2016 WebReport Market Update. Hi, I'm Arthur Coyne, Senior Research Analyst. The election of Donald Trump on November 8th was a major influence on U.S. financial markets through the remainder of the year. Trump's pro-growth platform and plans for tax cuts, deregulation, and increased military and infrastructure spending pushed the S&P 500 index up 3.8% for the quarter. The exchange value of the U.S. dollar climbed to a 14-year high on rising interest rates and growth expectations. Good news for consumers of imported goods, but a challenge for manufacturers who export. For bond investors, Trump's election was viewed as unwelcome news because the president-elect's planned fiscal stimulus, combined with his restrictive trade and immigration policies, could lead to higher inflation. Bond prices, which had been gradually declining since July, turned sharply lower following the election, posting their worst quarter in over 3 decades. There was wide dispersion between winners and losers in the fourth quarter. Energy exploration was among the leaders, driven by higher oil and natural gas prices. And financials jumped on hopes that the incoming Trump administration would relax industry regulations. Small cap value, which is heavily weighted to financials, rose with the sector, and the U.S. dollar rose with higher interest rates and improving growth prospects. On the other hand, U.S. large cap growth companies barely participated in the rally. And among the decliners, U.S. intermediate, long duration, and international bonds all performed poorly, as did bond alternatives such as real estate equities and gold. This poor performance of safe haven assets was consistent with the notion that investors were hungry for risk in the fourth quarter. As 2016 drew to a close, the U.S. economy appeared to be on track for both moderate growth and inflation. Citing solid job gains and moderately rising household spending, the Federal Reserve decided in mid-December that the U.S. economy was ready for another 0.25% interest rate hike, the first since December of 2015. Looking ahead, economists are expecting this gradual pickup in growth and inflation to continue into 2017 and 2018. Looking at growth and inflation around the world, we see a split between developed and emerging economies. Developed countries are showing up in a cluster with similar low to moderate levels of growth and inflation across the countries. For emerging market economies, on the other hand, the stories vary by country, with China and India reporting solid growth and moderate inflation, but Russia, South Africa, and Brazil experiencing virtually no growth but high inflation. In January, the IMF raised its 2017 worldwide growth expectation from 3.1% to 3.4%. When we review the performance of stability-oriented investments, we see a couple of things. First, we notice that most stability investments lost value in the fourth quarter as investors rotated out of safe haven investments in favor of growth-sensitive investments such as stocks. However, high-yield bonds shrugged off rising interest rates and continued to gain alongside equities on investor growth optimism. Low volatility hedge also provided positive results. And for the whole year, stability returns were positive across the board, with high-yield bonds being the standout leader with a 17.1% return. Among stocks, we continue to see small companies leading the way in the fourth quarter on rising investor optimism. For the year, stock results were positive across the board, making 2016 a rare instance of a year where returns were positive across every category of growth and stability that we track. As the year closed out, our tactical positioning remained in place with below benchmark duration, inclusion of high-yield exposure, and a bias towards U.S. fixed income on the stability side of the portfolio. Our positioning among growth investments remains tilted towards value with balanced U.S. and international exposure, overweight to small and mid companies, and inclusion of hedge strategies, real assets, healthcare, resource efficiency, and water themes. We continue to favor private markets over public markets for investors who can use them. Your advisor will keep you informed regarding these investment opportunities as they become available. Thank you for joining us this quarter.